So previously, we talked about how the city as a whole tends to grow and the different factors which might influence that growth, like industry clusters or city zoning policies or its development of city services. But right now, we're going to still look at cities, but take one step forward with respect to granularity. That is, we're going to talk about something called market segmentation and market analysis. And in doing so, we're getting one step closer to what I think many of you care about most, which is valuing an individual property for investment purposes. One of the original steps in doing that type of analysis is called market segmentation. And market segmentation is the analysis of real estate according to different market subgroups. If you're doing an analysis of a particular property type, such as industrial or residential, you have to focus your analysis on the market characteristics for that particular property type. That's the idea of market segmentation. So market segmentation is an empirical notion. That means that basically you have to look at the data and to think about it carefully. Ask questions and then dig into it further when you see something surprising in the data. And then with that, you develop your own story and narrative based on what you think the data is telling you. That's what empirical analysis is all about, whether it's for real estate or for something else. In property valuation analysis, we use market segmentation to first figure out which property types to focus on and which geographic areas to cover. Now, when analyzing real estate, we have to kind of simplify things, both for ourselves and for anyone that uses the results of our analysis, because let's face it, the real world is overwhelmingly complex. So we need to streamline to only what's most important when we do market research. Now, the book kind of frames this idea of telling a story, and I like that analogy. Basically, we're asking ourselves when we do an analysis the most important questions. What property are we studying? Who is the buyer? What do they care about? What about competition? We find the data to answer these questions and make sense of that data. If our story is still not complete, then we continue to refine our analysis, either by asking more questions or by collecting more data. That's the cycle of market research. If we start by asking those basic questions, what is the real estate product that we're analyzing? Who is the target buyer and target user? What do both of them care about? Or what is the competition out there? That all frames the data that we need to start gathering. For instance, in answering some of these questions, it's likely we're going to want to find data like rental rates for our area, for our property type, in order to understand demand. Or maybe what's in the development pipeline for the city for this property type to kind of better understand future supply and competition. So specifying your questions beforehand helps you think about which market parameters or key numbers that characterize the current condition and trends in the market. It helps you simplify your search for data from the outset. So, for example, for rental markets, typically we look at the current occupancy rate, future occupancy rates, and rental rate growth. If we're doing the analysis for a property buyer, we might be more interested in current and projected sale rates for the area. Or if we're looking at valuing a subdivision or a big new potential condominium project, we might want to look at data which can help us answer how many units will sell and at what price in each month, quarter, or year after the development period is over. So in doing market research, the book kind of advocates one of two approaches, like I mentioned, in particular this story approach to market research. But the second is what you might consider a more conventional approach, which starts by analyzing macro data at the national level and then successively drilling down to the state and then the city level. And from there, you can further drill down to the property-specific level. But since the book provides a lot more background for the first approach, this story approach, we'll stick with talking mostly about that here. And essentially with that, we're working backwards. We begin with the property itself and the market segment that it's in, and then we build only the relevant connections to the larger economy with that. In that way, it's a little more streamlined by focusing on only the relevant macro data. When you start with the top-down conventional approach, by contrast, it's easy to tend to include more data collection and analysis than you really need for your work. So we're going to take a look at an example of property market research as a kind of case study approach to learning. It'll be of a proposed planned unit development, or PUD, known as Elysian forest. And note how this example is of a proposed development. We're using property market research to figure out whether it's worth building or not, whether or not there will be enough demand if we build it to make it economically viable. And then also, just as an FYI, there are a couple of additional examples in the textbook of this kind of walkthrough for some other property types, in particular, I think for a proposed office building and for a proposed apartment expansion. So definitely take a look if you want to do kind of a deeper dive in how to do this type of analysis. Okay, so first up, we have that proposed planned unit development called Elysian Forest. And this is a proposed development in a college town by a large national developer. If you recall, a planned unit development, or PUD, it's a residential development that is a little different from traditional residential subdivisions. I mean, for one, because PUDs tend to be a blend of housing, including like townhomes, apartments, and single-family homes, rather than just a single housing type like single-family homes. Individual lots in PUDs tend to be also smaller, maybe even without side yards, so they might look a little bit more like townhomes. And the area within the PUD, it usually includes some nice park-like common areas and maybe some recreation facilities like a community center or a play place. So this proposed PUD development is a bold move for the local college town in this case study, which we're going to call here University City. One reason is that it's the first PUD for this city, but more importantly, it's several times the typical size of a new development for the town, with 900 proposed units. Above are the developer's proposed estimate of sales for each of these 900 units by year. They don't expect to sell them all in the first year that it's built, but rather in stages over the 5 years following development. That's a very common process for developers when they do these forecasts. So 88 sold in the first year, 212 sold in the second year, and so forth. One of the first things that's important to do in a market analysis is to look at estimated demand for housing in the relevant market area. And this is kind of our story approach to market analysis in action. We begin with a property and its market segments, and then we build links to the larger economy. So we're going with the property first and then going wider, rather than starting at the national level and then drilling down. So that estimated demand for housing in the town of University City, that's shown in the table below. The first row, all sales, shows 1,500 sales of property in the first year, 1,500 in the second, 1,550 in the third, and so forth. And this data might come from looking at the volume of previous transactions for a residential property in the area each year. So maybe from the MLS, So the MLS is like a local database, which places like Zillow and Redfin specialize in aggregating and making more publicly accessible. It's a database of property sales for residential properties. You can also directly download market statistics on the MLS for a specific area from Zillow. Zillow Market Research, it's called. But now, of these 1,500 sales for the first year, in this row, the table on in the bottom, only 500 of them, or about a third of them, are projected to be sales of new property rather than of sales of existing previously built homes. So of these 500 sales of new property in the first year, Elysian will be selling 88 of them if it's to meet its projections. And we'll talk more about this market capture ratio idea in just a minute. But first, just to give you a more of a visual of what's going on, here's an example of the style the developer is planning to build with Elysian Forest. And you can see no side lots, with instead mostly zero lot lines, kind of like what you have a lot in San Francisco. Probably small lots in the back, and a mix of townhomes and more SFR-styled residences. By contrast, here's what looks like the typical building of existing local properties for University City. You have more yard space, you have setbacks, and everything is detached, so no homes are connected to each other. The layout of Elysian Forest is more spread out, though, the layout of the entire planned unit development, with a kind of patio home clustering, meaning that properties are grouped together. Like in that image we saw with two properties back to back, but these groups themselves are kind of scattered across the development. So with the facts about the property mostly defined, let's begin market research and a market defining story. First, what is the product? As we've seen, it's mostly these clustered homes and townhouses. Relative high density, and this is new information for you, it's high end, insofar as the lowest price unit is higher than about 70% of the existing house prices recently transacted in the market. So the developers, they're definitely targeting higher income buyers. And these buyers, these customers, we can probably expect that in addition to being high enough income to afford one of these properties, the buyers are probably not going to be big families with young children, because if they can afford it, they're more likely to buy one of those existing properties that we just looked at with plenty of yard space. Even if they're high income, they may be more interested in putting that money into more square footage rather than the newer condition of the property that this development would be offering. So the target market is more likely to include retirees, a mix of adults, and maybe still families, but they're probably a bit smaller in size. If they're targeting higher income, smaller households, maybe the developers can, target young faculty at the local medical facility or medical residents who are in the beginning stages in career and family. So what do the customers care about? We can assume that buyers, they want an easy commute to local employment, and in addition, good recreation facilities, maybe good modern design to differentiate from the existing housing stock, which is a little bit older, and to offer value justification for these higher prices that the developer's targeting. And how is the competition? So let's suppose that based on our research, this is where we have to do a bit of sleuthing and general Googling around, basically. But let's suppose that we find that there is no other project right now similar to this development, other than the occasional home offered by local builders that tend to be more upscale and more modern. So, a lot of information. How can we summarize all of it into a kind of narrative? And a visual may be helpful for that, which is shown here. Our core market for this development targets a house price range at the 70th percentile to 92nd percentile, meaning that it's going to be more expensive than 70% of the properties out there in University City. Across different residential buyer types, it's probably going to appeal to retiree or empty nesters, as well as families of smaller size or just individuals. And it's worth noting that of the working population in the city, it's targeting only those with incomes that want to be owners, high incomes that actually want to be owners rather than renters of residential property. So at the end of all possible points in this population spectrum which we could sell to, we're really only in this gray boxed area labeled in this image with the words core market segments. That's a good next step in our research because now we can focus on our data collection, say from the US Census, on only parts of the population in this gray boxed area. That'll save us some time, and by focusing on only these groups for data collection, we'll also be more accurate when it comes to gauging the level of market demand. One census data source for that is called the US Census American Fact Finder. This is a data set put out periodically by the census, which contains, among other items, tenure by household income in the past 12 months. And that can tell us the number of owner households according to different levels of income brackets. And in addition, we might look at income by family type, the second census table here. That'll allow us to find the relevant income data for just our target market for this property. So let's say we did that data collection and we found of the 48,084 owner-occupant households in University City, we found that 10,121 were within an income range high enough to afford one of these proposed properties. And we know that large families will probably not be buyers of these essentially yardless homes. And so we subtract out those 3,479 households, which we were able to identify those using that second census table that we just talked about. So that leaves us with 6,642 potential households able and probably willing to buy. Out of the 48,084 owner-occupant households in University City, that's about 13.81% of the market that could be potential buyers. That's the volume of home buyers that could be interested in Elysian Forest each year. So armed with this new data, we can then go back to our proposed market share table and use it to match potential demand, or those households willing and capable to buy, with available supply, matching demand with supply. So let's take a look at that old market share table just as a quick refresher. So pulling up that table again, if you recall from our earlier discussion, in year one after the PUD is developed, we were estimating 88 homes in the development that would be sold. And that year one sales for the entire city of residential properties, that was expected to be 1,500 units. Let's take those 1,500 expected real estate transactions in year one, which probably came from looking at historical MLS or Zillow sales volumes, as well as the year 2, 3, 4, 5 all sales figures, and then jump back to the previous slide. Remember that this slide, we're using the new data on potential demand, or those households that are willing and capable to buy, that came from the census, and comparing that against expected available supply. Let's start with just year one here. Our year one supply comes from that 1,500 number. That's the volume of sales transactions expected in year one. And we expect that for this town, 13.81% of homeowners would potentially be interested and able to buy. So if 1,500 of those homeowners are active in year one, then really, given we're only targeting a specific demographic in sale volume terms, we're only going to be able to attract 13.81% of those sales, or 207. 13.81% of the 1,500 total sales. We're only getting a small subset of actual sales that are going to occur because we're only targeting a small demographic. So that's where we get that 207 number in year one. It's 13.81% times the 1,500. The thing is, that 207 number assumes that basically we have zero competition, that for this demographic, we sold all the homes. Every potential buyer turns into an actual sale as well. And we know that both of these are unrealistic assumptions. And that's why developers, when doing these types of forecasts, they add something called a capture rate. And there are ways to more accurately quantify a capture rate, and a lot of it looks at existing development in the pipeline for properties in the area, which are in the same market segment as the property you're studying. But a 20% capture rate here, which we're using, would probably be on the high side, even though capture rates, they can vary by market regions and definitely by property types. But this 20% capture rate, it means that we're expecting of the competition out there for similar properties and for this demographic, whether it's, other new high-end development or just generally nicer, more modern homes, that this project is going to capture 1 in 5 of every one of those sales. So 1/5 of the market for buyers with higher incomes and smaller families for this town. And when we apply that 20% capture rate to our total potential pool in year one of buyers of 207, we get expected sales of this project in year one 41. And that's less than half originally anticipated by the developer going into this analysis. And it gets worse in years 2 through 5, since the volume of homes sold in this market doesn't really change. The volume of homes is basically projected to stay constant. And the capture rate itself doesn't change either. Still getting 20% each year. And so it ends up that the company is likely to way undershoot the amount of homes it's going to sell in this project, based on our analysis here. So at this point, the market analysis tells us that this development is a no-go. I mean, maybe we can lower the quality and cost of homes to appeal to a bigger pool of buyers. Or maybe, if this is an area with a lot of families, another thing we can get from the census, we really should just do what the other homes have been doing in town historically and make the lot sizes larger. But either way, it's back to the drawing board with the design of this development and answering these potential questions to see if we can salvage the project. That would require another round of data collection and analysis, just as we did here. Because as it currently stands, though, this market analysis is telling us that we shouldn't proceed as it is proposed, as it's unlikely to sell very many of the homes. In fact, this was a real case study built on a real life example, an actual development that happened, albeit without the benefit of market analysis at the time. In reality, the developer just went ahead and built 20 of the units, staffed a sales team, and never sold a single unit, which in hindsight really goes to the lack of market fit, I think, for this property in this type of market. Because 20 units and associated administrative costs is also a very large outlay. Without sales, the project went into foreclosure and then the developer declared bankruptcy. So the moral of the story, I think, is to do your analysis. Look at the data and don't just shoot from the hip, which I think we tend to do too much in real estate. If the data is telling you there's not a big market for it, or if you're making a lot of assumptions to stretch the numbers just to kind of get it work economically on paper, it's probably not worth the risk. And we should just move on to other real estate opportunities. There's always opportunity. Why not just stick with the winning ones in real estate? Good data and good analysis can help you do that. Another thing about this case study we completed, the format, organization, and content of any report from our analysis or from our presentation of it, that all really doesn't matter that much insofar as it's going to vary for you from firm to firm or even from property type to property type. What is really important is that we defined our assumptions, such as who's going to want to live there, and we linked data to those assumptions in order to actually analyze it. So making assumptions in real estate investment, it's unavoidable because you're looking at buying or developing something for which financial performance, it's inherently an unknown. I mean, financial performance is in the future. So the best you can do is make the best educated guess that you can with the data that you've got and then model it. So this topic, we talked about modeling expected supply and demand and then concluded on the basis of that. And the next topic we're going to start our way into is the financial modeling of properties. But the same principle will apply. That is, we can never perfectly know how a real estate investment is going to pay off. And the best we can do is just deal with and reduce uncertainty through better analysis and market research. Now, a couple minor notes in wrapping up. First is to note that we just did a case study on a predominantly residential development, and that there are some differences between residential and commercial property markets. I mean, one is that office properties and hence prices, they tend to be more correlated with the business cycle. So when the economy's down, these properties tend to suffer a little more. And that's because when the economy's down, people still need somewhere to live and will continue paying rent if they can. And so residential rents and ownership rates, they usually tend to hold up during recessions better than similar figures for office properties. So that's a general rule. What's happening right now is slightly different because of what appears to be a fundamental shift in the amount of remote working that's going on. And that effect is going to take a while to fully shake out. But as a general rule, the greater sensitivity to business cycles of office properties remains true. A separate issue is the idea of cyclicality. This is something that relates more to the timing development of new property, although it can affect all properties as well as all property types. Cyclicality in the real estate market, it basically means ups and downs in the market. And these ups and downs, they may not be related to the general economy. So instead, cyclicality in real estate markets, it can occur because of changes in supply and how changes in supply tend to come with a delay. So it can easily take a few years or more to build a skyscraper in downtown San Francisco, for example. Like a developer might decide to build a skyscraper right now because the local economy is great. But it'll be another 5 years before that tower actually comes online and starts generating rents. And in the meantime, demand for property may have shifted so that there's a lot less demand than originally forecast, maybe because the economy has hit a downturn. So then financial performance ends up worse than expected. And what commonly happens is that when times are great, the developers, they all tend to build at once. And they all have kind of these really rosy financial forecasts. And the problem then, and this is kind of how cyclicality is created, is that with these large lead times, you end up having a very large supply of new construction in the pipeline. And then they all tend to hit the market at once, but with this delay. And so then, of course, supply and demand stays, all else being constant, if demand stays constant, then all this new supply suddenly hits the market, and those rosy forecasts based on, supply 5 years ago are now out the window. So cyclicality in real estate, it can be due not just to market downturns, but to this delayed feedback loop with multiple developers in action, but caused by these long development times in construction. A couple more concepts to introduce that are used in real estate, not just in development, but real estate more generally. First is on the right here, a geographical information system, or GIS is how we usually say it. And you'll come across GIS databases all the time in real estate. So most tax assessor websites, for example, they provide easy access to their GIS database of properties through just a web browser. You can access it online. So GIS data, or GIS in general, allows you to browse graphically, browse different data sets graphically by looking at like a top-down view of a particular region. And Google Maps, kind of like a mega GIS. But real estate people, they tend to use their own GIS systems for various purposes that are specific to them. So this image here, for example, is a picture of accessing the GIS system that the San Francisco Planning Department puts out. And it allows you to zoom in to individual buildings and then get data on them, like building permits or environmental information, like if there's been any contamination, zoning, that sort of thing. And the data that you can show on a GIS, it's very flexible. For this planning department, of course, they have planning information, but you can have tax information, you can have population, very flexible. Basically, it's a map that allows you to access data. And then psychographics. Psychographics is another concept, probably not something you'll encounter a lot directly in the real estate world, but it's the process of using data from like the census as well as maybe private sources, and then building statistical models to identify and then predict particular demographics across geographic locations. So it's used a lot in identifying where to place new stores. You know, where do I place a new Gap store? That depends a lot on who your shoppers are going to be nearby. It's used to kind of decide on what style of housing to build. Like, actually our case study is a great example. Should I build close, dense condos or mixed use type of residential structure, or should I have spread out housing? That sort of thing. And really just anywhere in which you want to target a particular customer segment and you're trying to figure out the best geographic locations to do that. Survey research is another way to get at customer profiles and preferences, although it has to be done correctly. I've seen survey research go wrong in so many ways in real estate because it's very easy to accidentally ask leading questions when you survey people for what they want in a property, or for like how much they'd pay for a property, etc. Leading questions, by the way, are like, this is great, right? Or you would do this, right? That's a leading question because you're asking for a confirmation at the end with a right. But there's many different ways to accidentally phrase a leading question. So you have to, really, usually you need to have surveys professionally designed if you want accurate results, or at least professionally reviewed. You can do the questions and then have a survey expert take a look at them to kind of make sure those questions follow generally accepted methods for designing good surveys. But that sort of thing is beyond the scope for us. Survey methods tend to be a separate class, or you could even do a field of specialization for a master's degree in survey research. But another problem with surveys is that people tend to say one thing and then do another. So especially when it comes to money. You can ask someone, would you pay $500,000 for this house? And they'd be like, yeah. But in reality, they never pay anything close to that, if at all, if they buy it at all. And so as the adage goes, like, talk is cheap. And so when you ask people about these types of things in surveys, you don't really know that you're getting an accurate answer. And so my personal preference might be coming out here is that if I want to see whether there's a market for a property, I tend to want to look at market data. I want to look at transactions that have actually occurred in that place rather than rely on surveys. Because as they say, talk is cheap, but when you look at actual transactions, that's a record of people actually spending money and making decisions with money involved. And so that's a more accurate assessment of reality. And I like that when I'm going to gauge or use that data for investment purposes.